Welcome. Today we're looking at a piece on Rocket Lab, RKLB, that argues the recent 9% drop is actually a gift for long-term investors.
Right.
It starts off strong, highlighting fundamental strengths, 2 launches in just 48 hours, big revenue increases.
It does, and that part is great. But I think the assessment of the immediate negative sentiment, particularly around the executive actions, needs more robust mitigation before pivoting to those positives.
I see that. It's like it acknowledges the bad news, but doesn't really fight it.
Exactly. The piece lists these significant drivers for the drop, the Neutron delay, the CFO Adam Spice selling shares. But it sort of just concludes they're insignificant without really showing the work. The audience needs to see those fears dismantled, not just dismissed.
So the suggestion here is to, directly integrate the company's financial strength to neutralize those specific risks?
Precisely. Prove that the dip is technical, not fundamental.
So, for example?
Well, take their liquidity position, over $1 billion. You should explicitly connect that money to how it buffers any impact from the Neutron delay.
Okay, that makes it tangible.
And with the CFO's insider selling, don't just leave that hanging there. If you can, add some context. Was it a scheduled 10-551 sale? A tiny portion of his holdings? Context disarms the fear.
That's a much sharper way to frame it. Okay, let's shift to the second point, the long-term view. The piece talks about high price targets, calling the current price of around $39 a gift.
And that's a bold claim to make. The concluding argument that the stock is a gift must be better substantiated by clearly linking the existing contract backlog and their, really impressive margins to that future valuation.
So it's missing the bridge.
The bridge is missing. It throws out the numbers, a $1.1 billion backlog, a record 37% gross margin, but it doesn't spell out how those figures justify the huge gap between today's price and those analyst targets.
It's like showing someone a pile of bricks and a blueprint for a skyscraper, but not explaining how one becomes the other.
That's a perfect analogy. So the suggestion is to frame those financial wins as the primary justification for the buying opportunity.
Make it more concrete.
Yeah, make it concrete. Focus on the Electron rocket's dominance in its sector. That creates recurring revenue, which is what justifies that high 37% margin.
Okay.
And crucially, instead of just listing the billion-dollar backlog, frame it as future guaranteed revenue. That acts as a powerful floor under the valuation, right? It makes the current price look logically unsustainable if that growth continues.
So to recap then, the actionable suggestions are, twofold. First, you need to better integrate the company's financial strengths, like that $1 billion in cash, to actively mitigate those short-term risks you brought up.
Right. Diffuse the negatives.
And second, enhance the link between that backlog and the high margins, connecting them directly to the long-term price targets to actually solidify that gift thesis.
Exactly. I'd encourage you to revise the analysis with those points in mind. Shore up the risk section, build that stronger valuation bridge, and then please do submit it again for another look. We'd be very interested to see the